Okay, so a very interesting topic that we have got for our viewers today. And Feroze, just reading to the data, back in 2022, Nifty gave almost a flattish sort of a return, was up in single digits. But the major factor was that the FPIs were pulling their money out of India. It was almost 1.2 lakh crores of outflow that FPIs have done. But thanks to the DIIs that did support the market movement. But if we see 2023 coming, the first half, or rather the first 2 to 3 months, they were depressing. The FPIs were still pulling out. But what a recovery, or what a comeback that they have made. 94,000 crores worth of pump in terms of investment is what they're seeing. And look at the move in Nifty 50, almost near to its life high level. So how should one read this data? Is it that so that whenever FPIs or FIIs will make a comeback in the Indian markets, then only we will see the market moving upwards, or when they are pulling out, the markets could give a depressed sort of a return? What's your understanding, and what does the history tells?
Srishti, I'll answer this in parts. There are quite a few things which a person can infer from the piece of information which you just articulated. Firstly, I think what has happened over the last decade is a structural change of Atmanirbhar capital markets. Let me substantiate with the point. Like last year, FIs took away 1.2 lakh crores. That's a lot of money, right? That's more than 12, 13, 15 billion dollars going out, and the market being marginally positive. That implies that 10 years back, if the same thing would have happened, markets would have closed that year with a minus 20% tick. But why did it end 1% higher in the financial year in question? That's because in SEBI tried to make one change. Structurally, two large changes were made. One of which was done in 2013 and the other one was done in 2018. SEBI in 2013 started educating Indian investors to get a reasonable pie of the domestic Indian household saving. The Indian household saving as we speak is 670 lakh crore, okay, which only 21 lakh crores is equity mutual fund. Look at the power of the Indian household, 670 lakh crore. So when SEBI started educating the Indian investor by starting an education initiative using mutual fund as a platform and AMFI as a platform, that has changed the mindset of the Indian household from seeing a mutual fund as a risky instrument to the logical, most safest product platform from a transparency standpoint. That's one thing which has made sure last year you didn't fall. Second thing which SEBI did in 2018 was simplifying the life of the investor. And that's why you see 14,700 crores in a single month coming from the Indian lower strata. That's 2022 for you. And this data, why is it very important? Is because this will tell you over the next 10 years, how buoyant will our markets be? That's point one. Point two is the domestic flows have been robust and they will become far more robust. And I have already predicted it on your show that in the next 3 years, you will see 25,000 crores every month coming in the form of SIP. I had said this when the SIP numbers were 8,000 crores, and I reiterate that you will surely by FY27 reach 27,000 crores of monthly inflows from Indian domestic households. So it will be a very buoyant market. Then coming to the volatility point, you would be very happy to note and have immense pride as an investor and an Indian that the volatility, if it's numerically measured in the form of standard deviation, has been lower than the US markets, which is 100 years more older. That's because of the domestic flows. So the risk levels of India has come down significantly, because if you measure it in standard deviation, which is how volatility is measured, like return is measured in compounded returns, risk is measured in standard deviation most popularly, and we have produced lower risk than the US market over the last 1 year. And coming to 23, I personally think the FIIs will return. I was just there in Paris on a global event last weekend. This weekend, I would like to say. And I've met about 500 global investors, and their take on India has dramatically changed over the last couple of years.
Feroze, you seem to be echoing the positive view on the Indian markets, definitely. But before we go ahead and talk about the other touch points like SIPs and the fund inflows, just wanted to ask you, when are you expecting Nifty to touch their all-time high levels? Because it has been a touch and go movement for the past 1 month. There has been many instances. So we are just a century or maybe 200, 300 points away from the all-time high levels. But what's your expectation? When can we see that happening?
See, Srishti, to be honest, that will require some crystal ball gazing, which I don't have. But I personally think, of course, as a sentiment standpoint, as a happiness standpoint, a peak makes a difference. But if you look at a 1 year, 2 year, 3 year kind of time frame, getting more than the double-digit returns on Nifty is upwards of 90% probability. Of course, there's 10% probability of things going southwards, which is always going to be the case. But if you ask me pointed, I think this year a peak should be established. It should be around the corner, but because just 0.5% away from the peak, which is about 18,858, if I'm not wrong. We're just hovering there and we have not touched that so far. So I think this year is going to be good. Last year wasn't good. So the probability of the future becomes better if the last 4-5 years have not been stupendous returns. Of course, after COVID, the correction, the market has moved up. Now coming to very pointed inflation, which is the global concern, doesn't exist for India because the inflation numbers which we produce are lower than the last 10 years average of inflation. US has produced inflation numbers which are 400% more than the average of the last 10 years. So whatever is the globe's problem is business as usual for us, is why we are a brighter spot and attracting global inflows. And I think it's just scratching the surface currently.
Okay, thank you for that take, Feroze. But moving on, getting back to the SIP inflows that you were touching about, you are expecting that 25,000 crores is what you are expecting from the inflows, and now the data stands at 14,749. So that's an exponential, or rather a significant jump in the next 3 years, what you're expecting. But given the whole scenario and the setup that we have discussed, how the Indian markets are placed, which particular type of fund, be it large cap, mid cap or small cap, is expected to outperform? Because given the fact that FPIs have made a comeback in the Indian markets, especially since the March lows, the broader market space is definitely buzzing. So if one has to take a view going ahead that now that the FPIs are once again back and the outlook is also positive, then which particular type of fund they should be eyeing at for rather to create that alpha around?
Shishi, this is an easier question to mathematically answer than the previous one. So let me give you some mathematics. First, I'll tell you the headline. I would prefer having at least 30% in the small cap space for the next 1 year, at least 30%. On an overall implied basis. See, what happens is when you buy 10 funds, each of them might have some degree of small cap, some degree of mid cap. When you open all these 10 boxes and see the implied exposure, 30% could be in small caps, 20% in mid cap, and 50% in large cap. Mid cap being smaller than small cap is a huge message that from a relative valuation standpoint, the 150 stocks which are called mid cap stocks are a little overvalued. Hence, we think that the large cap is attractive, the small cap is attractive. The least attractive of all these three segments is those 150 stocks, which are called mid cap as per SEBI's definition from a mutual fund investor standpoint. That's point one. Point two, why do we believe small cap will do well? Is because the rear view mirror has a very shoddy picture. Last 5 years, small cap has underperformed Nifty by 4% every year. Every time this has happened, that small cap has underperformed for 5 big years, the next 3 years have always been good for the small cap period. Since the rear view mirror is showing a very ugly picture for small cap, the probability of small cap outperforming the Nifty goes up significantly. And if history has to be believed, there is 95% chance that small cap will outperform Nifty over a 3-year holding period from now on. So at least for 1 year, you should have 30%. If small cap does very, very well over the next 1 year, if it so does, fingers crossed, then you may want to lighten your small cap exposure. But this question needs to be re-answered a year from now.
Okay, thank you so much for highlighting that data, how the small cap, when in instances it has underperformed, then one can expect the outperformance in the times ahead and how you should definitely place yourself out here. But if we talk about the return over the past 22 years, what you have shared is that Nifty in the past 22 years has given at least 12.5% of return on a per year basis. So going ahead, Feroze, do you expect this particular number to be stretched even more, given the fact that the FPIs, or like you were highlighting as well, that the FPIs are very much positive on the Indian markets, and we are seeing the retail participation coming in a big way? So what's your understanding for the markets, and what kind of an expectation in terms of the EPS for Nifty 50 is what you guys are factoring for?
Yes, so there are a lot of questions in this, Srishti. I'll try and answer, and I would not try not to miss all these important ones which you asked.
Okay.
When you look at bullishness from FPIs and domestic inflows, an investor should look at this money as a risk mitigant, not as a return spinner. If you have bullish, marginally bullish FPIs and good domestic flows, then the drawdowns in the market are not going to be as steep. Like, what should an investor worry about is the COVID-like kind of situation where the markets fall like a knife. Markets every year fall from peak to trough almost 19% every year. So markets are going to fall. That's the nature of the beast. An investor needs to be mentally prepared for at least a 10-15% drawdown every year from peak to trough, because 22 years history says market will find its reason to correct. But the problem happens when a 2008 or a 2020 happens. Then an investor becomes very difficult for an investor like you and me, Srishti, to be in the game, to look at the light at the end of the tunnel. So point one, because of this bullishness of FPI and domestic flows, markets are going to be buoyant, and sharp falls like GFC and the COVID are very, very unlikely. That's point one. Point two, coming to the EPS earnings. We were one of the very few wealth management outfits which predicted an earnings growth of 30% when Nifty's earnings moved from 535 to 772. And then last year, it closed at 840. If you remove the one-time expense of Axis Bank when they bought the Citi business. 840 was the earnings last year. We predict this financial year to be 936 earnings. So if you look at all these 3 years put together, which is how an investor should look at, 535 to 936, that's one of the sharpest earnings growth in the globe. And that's why markets have not supported a bear and supported the bulls, because the corporates are doing well, and 936 is our earnings estimate for this year for those 50 companies. And that makes markets in a reasonable range of valuation.
Okay, markets looking in a reasonable range of valuation. Thank you so much, Feroze,